The Fed game, the game with the Fed. The game with the Fed is really an analysis of how markets react with the Fed. I think it's an interesting thought process. It's an interesting case study. It's one of the probably most interesting fields of economics. And just to be clear, it is a little bit unfortunate that we have to do this because if we didn't have a Federal Reserve, or if we had a rule-based Federal Reserve or some sort of Bitcoin money, we wouldn't have to do this. This whole game with the Fed, as we call it, is a lot more costly than beneficial. But this is our opinion, and of course we don't make the rules. The history of the Fed has shown that it was created for reasons that actually have nothing to do with what the so-called mandate is of the Fed. It was created for very other reasons. I want to talk about this, but I want to focus on the game theoretic implications of the Federal Reserve. In short, the only influence the Fed really has is to signal to the market that they will do something, and then the market participants actually try to front run the market by, let's say, selling stocks because the Fed might raise rates, and then hopefully buy them later when the Fed stops raising rates. And that's why the markets react. So the markets really react because it's a game. There's no fundamental reason why you should sell stocks when the Fed signals stop. This is our main thesis here. This is a Not Even Wrong podcast.
It's March 25th, 2021. This is Krim Dalko.
Since the last update, the fund is up 8%. The market's up 1.5%. For the year, we are down 11.1%. The market's down 4.5%. We're underperforming by 6.6%. So let's first start with what is the Federal Reserve, why was it created, and then why we think that the whole analysis of the Federal Reserve, the way it's portrayed in the popular media and in the financial press and all of that stuff, is wrong. The actual reason the Fed has influence is purely game theoretic. So let's start with the Fed was created in 1913, the Federal Reserve Act. There's a fascinating book, and I put in the show notes. I forgot this. This person wrote a book about the history of the creation of the Fed, and I really recommend this to anybody. The purpose of this podcast is to give people a sense for what it feels like to run a hedge fund. I've said many times that reading is part of the job of a hedge fund manager, and you can read anything, Greek mythology, poets, poetry, all that stuff, or you can also read a book about the creation of the Fed. Everything is useful. But what's really useful about the creation of the Fed is really you understand that one of the main players that impacts stock market behavior is the Federal Reserve. So understanding why and how the Fed was created, I think it's a huge positive. So the Fed was created in 1913. There was a big fight between bankers in New York and politicians, particularly in sort of the Midwestern states, the Republican states of today. Back then it was a little bit different, but let's say what we would call very hardcore Republicans today in states like Oklahoma, and then the other side was bankers in New York. And the main purpose of the creation of the Fed was to have a safety net for banks. This was the main purpose. So Wall Street wanted to create an insurance, kind of like a place where banks can go if the proverbial shit hits the fan, excuse my French. So that's what they wanted. Now, of course, they wanted this for their own reasons. They didn't want to go bankrupt. Bankers, particularly in the early 20th century, still had their own skin in the game, their own capital. They weren't public companies. So if you're a banker on Wall Street, you want to have an insurance against risks like run on banks and all that stuff. Now, to be fair, some of that is systemic. So you can make an argument that saving Wall Street through a Federal Reserve system is or has systemic benefit. This is not just their own skin, but still the purpose and the motivation and all of these things certainly was not to have some sort of economic growth engine or even like a place where, let's say, job creation is being instrumented by central planning. None of that stuff. It was meant to save banks from failure. And again, we had a lot of bank failures in those days, and the Federal Reserve has created a system that makes bank failures more difficult. We've seen that in the past 20 years. After the dot-com bubble in the early 2000s, then in 2008, the Federal Reserve has stepped in several times and really saved a lot of banks from failing. Not all of them, and a lot of banks did fail, But the main difference between a system with the Federal Reserve and a system without the Federal Reserve is that a system with the Federal Reserve is a system where bank failure is a political choice, and in a system without the Federal Reserve, it's more of a natural outcome of things. And that's what the bankers in New York were scared about. They didn't want the natural process of things to go in a way that everybody goes bankrupt, and then we have sort of a new phoenix rising out of the ashes and all of that stuff. We wanted to have a system where a central bank, politically controlled, is there to make sure that that bank failures don't happen. To be fair, again, when you read the story of the creation of the Federal Reserve, it's of course very politically laden, and like everything else, information is theory laden. So, excuse me, you can always interpret things like that, or you can say the greedy bankers in New York, or you can say no, they came actually from a different place, because they didn't want people like JP Morgan to have so much power, so they wanted to spread the power. No matter how you look at it, the creation of the Fed, the purpose of the creation of the Fed was there to save the banks. Now, having said that, after the Fed was created, it became a political animal, which was very well predicted by particularly those, let's say, Republican-leaning senators who were against the creation of the Fed. It became a political animal. It became a sort of a game of Congress and the White House playing around with the Fed, because the Fed has a lot of power. And the purpose of this particular episode is to shine a light on where we believe the real power of the Fed lies. Now, the real power of the Fed lies in two things. One, the Fed can decide who goes bankrupt and who doesn't. So the Fed has the ability to decide who wins and loses in the game, particularly in terms of the financial game. So this is a huge power. But more importantly for us investors is what the Fed does is it influences the behavior of financial market players. And how does it do that? Through game theory. When the Fed signals, for example, that it's going to raise rates, people start selling assets because they anticipate other people selling assets, because they want to front run those people who will sell assets and then buy them cheaper. So in other words, when the Fed signals that it's going to raise rates, what it's really saying in plain English is that for a certain period of time, we will have a sell-off in assets until the economy slows down and we stop raising rates, and then we actually lower rates again. And what that really means is it's irrelevant about the actual level of interest rates. It's not that important. What matters is we're in a new regime, we're in a raising rate environment, or we're putting the brakes on environment, or again, most importantly from our perspective, we're in an environment where stocks will sell off. And if we're in an environment where stocks will sell off, you better sell stocks early so you can then buy them back cheaper. Because fundamentally, and this is anecdotally true, people like Warren Buffett have said that many times, lots of entrepreneurs like Elon Musk say that all the time, long term, we're going to be fine. In the long term, we're going to be fine. But financial market players are not long-term thinkers. The reason they're not long-term thinkers is because it's their job to trade. It's their job to try to exploit the financial markets. And what better place is there to exploit than the Federal Reserve? What better place is there to actually try to guess the future of financial assets than looking at the signaling of the Fed? Because the signaling of the Fed has real impact on the behavior of financial market players. It has it has the best impact of the behavior of financial market players probably above anything else, maybe with one exception, which is things like war. If you start a war, of course, you can also predict what's going to happen with the behavior of people. But other than that, the actual impact of the Federal Reserve on the behavior of financial market players is the best out there, and therefore people take it seriously and they start behaving. And now there's a self-fulfilling prophecy. Of course, if everybody thinks that after the Fed has said, let's say we're going to raise rates, that assets will sell off, well, then everybody will rush and sell assets, and then there will be a sell-off in the markets, and then people at some point will start buying back stocks, because again, fundamentally in the long run, stocks will go up, they drift up. I think many empirical models have shown that the reason stocks drift up is because we have real wealth creation in the economy, particularly in the US economy. Not in every stock market, but in the US stock market, there is real wealth creation, and therefore there's a positive drift in the stock market. And that's why in the long term, you do expect to make a return on your investments in the stock market. But that's not what most financial markets players care about. What most financial market players care about is the short term, because they try to exploit markets. Now, of course, when we talk about financial market players, we have to be a little bit more differentiated. For example, there's players like us, we are long-term players, we tend not to trade around these things. But if you look at the constitution of the financial markets, if you look at the real, like who is in there, let's say there is the traders, there is the Wall Street banks, there is the research departments of Wall Street banks. In short, a lot of people in the financial markets are incentivized to have an opinion about the short term. This is, I would say, a bug in the system. It's not a feature, it's a bug in the system, in a sense that because people have jobs, they go to work every morning, they have quarterly meetings, they have annual reviews. Like the way we humans tend to work is like on a daily basis, on a quarterly basis, and all that stuff. And because we have that, we have this pressure to continuously produce something. Now, in certain industries, that makes sense. If you're Tesla, you continuously produce cars, and you can actually measure your productivity on a daily basis. The problem with the productivity of financial markets players is it's not linear. And therefore, the right way to think about financial markets in general and being a player in the financial markets is not how much did I do in the last quarter, but it should be what am I doing to maximize my productivity in the long run, because I don't know when the returns will come. The returns are erratic. They can come in 2 quarters, and then for years there could be nothing, and then again you have this burst of productivity. It's not linear. That's my point. Somebody asked me recently, do you enjoy life all the time? Is that what you do? And I said, look, I don't. I have a job where I can enjoy life. That's true. There's a lot of times when I'm idle, but I often compared our job with sort of a Navy SEAL team where we are idle for a long time, but then we have to act very fast. We have to sort of, things happen very quickly, and then we have to get involved very quickly. And that's those are the kinds of things where I think a lot of people shy away from being a hedge fund manager because it's very difficult to be actually in a position where you don't have this linear feedback. I go to work, I get something done. It's very difficult, but that's besides the point. I think, again, the purpose of this podcast is to give people a sense of what it feels like to run a hedge fund. So you do have this is a very important part, but I think this would be an episode on its own to talk about this. What I want to talk about is more the institutional sort of fabric of the financial markets is such that people always want to do something, and the Fed gives them a great reason to do something. And because everybody thinks that when the Fed signals rate rise that they sell off, then the stocks sell off, and there's a front running, there's a game theoretic sort of situation going on, and then once that fizzles out, people buy back the stock. So that's why we have this volatility. In other words, the Fed actually adds to the volatility. Now, having said all of that, unfortunately, we have the Federal Reserve. It's very difficult to undo the Federal Reserve. I think the remedy to this would be that if we could have a rule-based Federal Reserve that doesn't have discretionary power, this would be great. But of course, there's mission creep at the Fed, there's mission creep with politicians. Everybody wants the Fed to actually have more power, because if the Fed has more power and you can get the hold of that power, then you have real power. Again, you have real power in a sense that if you can be the one who first signals, let's say, a rate rise, then you can profit the most from Federal Reserve actions. So to summarize, the Federal Reserve's main purpose is to save banks from failure. One of the collateral damages of having a Federal Reserve is that the Federal Reserve adds to the volatility in the market because of the signaling and because of the front running and the game theoretic implications that the Federal Reserve has with relation to the other financial markets players. And the remedy would be to have a rule-based monetary system. Unfortunately, we don't have that, and I think one of the big upsides of Bitcoin is to actually eventually get away from a discretionary Federal Reserve to a rule-based monetary system. If that is a political institution or if that is Bitcoin, that remains to be seen. But we at Orange Capital Partners are in favor of a rule-based monetary system, in particular because we don't like to be exposed to the induced volatility by the politically influenced Federal Reserve. Thank you.